How to invest in real estate with less than $5,000 is not only possible, it is increasingly common in today's financial landscape. Many beginners assume real estate requires massive capital, but modern strategies have lowered the barrier to entry significantly. In this first part, we will break down the mindset and foundation you need before putting a single dollar into the market. The first principle is understanding leverage. Real estate is one of the few asset classes where you can control large assets with relatively small amounts of money. Traditional ownership is not the only path. You can participate through partnerships, crowdfunding platforms, wholesaling, and creative financing structures. The second principle is shifting your thinking from ownership to participation. With under $5,000, you are not competing with institutional investors buying entire buildings. Instead, you are positioning yourself in micro opportunities where your capital solves specific problems for sellers or developers.
Third, you must understand market selection. Not all markets are equal. High-growth secondary cities often provide lower entry points and higher rental yields. Researching cash flow, population growth, job markets, and housing demand is essential before committing funds. Fourth, education is your highest return investment at this stage. Spending time learning deal structures, basic contracts, and negotiation techniques will protect your limited capital from poor decisions. Many beginners lose money not because of bad markets, but because of lack of understanding. Finally, discipline is key. With a small budget, every dollar must be allocated strategically. Emotional decisions or rushing into deals can eliminate your capital quickly. Patience and due diligence will separate successful micro-investors from those who exit early.
This script will guide you through practical strategies that allow you to enter real estate with minimal funds. Each section builds on the last, showing you exactly how to move from preparation to execution, even with limited resources available today. For example, many investors begin with wholesaling, where you find discounted properties and assign contracts to buyers for a fee. This acquires minimal upfront capital, but demands strong communication skills and market awareness. Another approach is real estate crowdfunding, where small amounts are pooled with other investors to fund larger projects. This allows you to gain exposure to real estate returns without direct ownership. You can also explore lease options, where you control a property with the right to purchase it later. This strategy often requires little initial cash, but can generate income if structured correctly. In addition, partnerships allow you to combine your limited funds with others who bring experience or additional capital, increasing your ability to close deals. The key is to focus on deals where your $5,000 acts as a catalyst rather than the main funding source. Think of your capital as a tool to unlock opportunities, not to fully finance them. By positioning yourself correctly, you can participate in transactions that would otherwise be inaccessible. Consistency in learning and networking will determine success more than the size of your budget. Real estate rewards those who understand systems. Part 2 focuses on the most accessible entry strategies for investors with under $5,000. One of the most popular methods is wholesaling, which allows you to act as a middleman between motivated sellers and cash buyers. In this model, you do not purchase the property yourself. Instead, you secure it under contract at a discounted price and assign that contract to another investor for a fee. The key to success here is finding distressed properties and building a reliable buyers list. Another strategy is real estate crowdfunding platforms. These platforms pool money from multiple investors to fund residential or commercial projects.
With as little as a few $100s, you can own a fractional share of a property and earn returns through rental income or appreciation. This method is passive and ideal for beginners who want exposure without management responsibilities. Lease options are also powerful. In this approach, you negotiate the right to lease a property with the option to buy it later at a fixed price. You can then sublease the property to tenants and generate cash flow while controlling the asset. This requires negotiation skills more than capital.
House hacking is another entry point. Although traditional house hacking often requires a mortgage, creative variations allow you to rent rooms, partner with owners, or manage shared housing situations. This reduces living expenses while building equity exposure. Finally, bird dogging is a beginner strategy where you locate potential investment properties for investors and earn referral fees. It is low risk and helps you learn the market without financial exposure. These methods show that real estate investing is not limited by capital, but by knowledge, networking, and execution ability. To maximize success in these strategies, you must develop strong networking habits. Real estate is a relationship-driven industry, and most deals are never publicly advertised. Building connections with agents, wholesalers, property managers, and private lenders increases your access to off-market opportunities. Attending local real estate meetups and joining online investor communities can accelerate this process.
You also need basic marketing skills. For wholesaling and bird dogging, your ability to find sellers often depends on direct outreach methods such as cold calling, SMS campaigns, and driving for dollars. This means physically identifying distressed properties and contacting owners to negotiate potential deals. Financial discipline is equally important. Even though some strategies require little capital, mismanaging your $5,000 across multiple weak opportunities can eliminate your entry point quickly. Focus on 1 or 2 methods at a time until you achieve consistency and results. Legal awareness should not be ignored. Contracts, assignment clauses, and lease agreements must be understood at a basic level to avoid costly mistakes. While you do not need to be a lawyer, you must know how to protect your position in each deal structure. Ultimately, these entry strategies work best when combined. Many successful investors start with wholesaling or bird dogging, then transition into crowdfunding or lease options as their knowledge and capital grow. The goal is to build momentum, not make a single transaction. Part 3 is about finding deals, which is the lifeblood of real estate investing. Without deals, even the best strategy will fail. The first method is driving for dollars. This involves physically or virtually searching neighborhoods for distressed properties, such as abandoned houses, homes with overgrown lawns, or properties with visible damage. These are often owned by motivated sellers who are willing to negotiate. Another method is using online platforms like Zillow, Redfin, and Craigslist to identify properties that have been on the market for a long time. Days on market is a strong indicator of seller motivation. Properties that fail to sell quickly often present negotiation opportunities. Direct outreach is also critical. Cold calling property owners or sending targeted SMS messages can generate off-market deals. Many investors build skip tracing systems to find contact information for absentee owners. This allows them to reach sellers who are not actively listing. Networking with real estate agents is another powerful strategy. Agents often know about distressed listings before they hit the market. Building relationships with them can give you early access to deals with less competition. Public records are another overlooked source. Tax delinquency lists, probate records, and foreclosure filings all contain motivated sellers. These data sources are often available through county websites or paid data services. The key to success in deal finding is consistency. Investors who treat it as a daily activity rather than a casual effort are the ones who build pipelines of opportunities. To scale your deal flow, you must systematize your approach. This means setting daily or weekly targets for outreach, property analysis, and lead follow-up. Many beginners fail because they rely on inconsistent effort rather than structured routines. Treat deal sourcing like a business operation, not a hobby. Technology can also give you an edge. Tools like property data platforms, skip tracing software, and CRM systems help you organize leads and track conversations. This improves efficiency and ensures no opportunity is lost due to poor follow-up. Another important factor is understanding sellers' psychology. Most motivated sellers are not purely driven by price alone. They may need speed, convenience, or relief from financial stress. Tailoring your offer to solve their specific problem increases your chances of closing deals. You should also learn basic negotiation frameworks. Instead of focusing only on lowering price, understand how to structure win-win outcomes. For example, offering flexible closing timelines or taking over repairs can make your offer more attractive, even if it is not the highest price. Building credibility is essential. Even with limited capital, presenting yourself professionally increases trust. Simple actions like having a clear introduction, being responsive, and maintaining honesty in communication can significantly improve conversion rates. Over time, your deal-finding efforts should evolve from manual searching to targeted systems that consistently deliver leads. This transition is what separates beginners from long-term investors who build sustainable pipelines. In the long run, consistency and disciplined execution will determine your ability to secure profitable real estate opportunities consistently over time and scale. Part 4 explores creative financing, which is essential when working with less than $5,000. Traditional bank loans are not always accessible to beginners, so understanding alternative funding structures is critical. Creative financing allows you to control or acquire properties using methods that minimize upfront capital requirements. One common method is seller financing. In this arrangement, the property owner acts as the lender and allows you to make payments directly to them over time. This reduces the need for bank approval and large down payments. It also creates flexible negotiation opportunities for buyers with limited cash. Another approach is subject-to financing, where you take over the existing mortgage payments of a property while the loan remains in the seller's name. This strategy allows you to control properties without qualifying for new loans, although it requires careful legal structuring. Private money lenders are also a powerful resource. These are individuals who lend capital based on trust, relationships, and deal quality rather than strict institutional criteria. With a strong deal and presentation, you can secure funding even without a strong credit profile. Partnerships are another form of creative financing. You can contribute skills such as deal sourcing or management, while your partner provides capital. This allows both parties to benefit from the transaction. Finally, lease options combined with subleasing strategies can create cash flow without ownership. By controlling a property under a lease option and renting it at market rates, you can generate income while preserving capital. These methods demonstrate that capital is not always the limiting factor in real estate investing.
To effectively use creative financing, you must develop strong communication skills. Sellers and private lenders need confidence that you understand the deal structure and can execute reliably. Clear presentation of numbers, timelines, and risk management increases trust and improves your chances of securing favorable terms. Due diligence becomes even more important in these deals. Since you are often working outside traditional banking systems, you must verify property titles, existing liens, and payment histories carefully. Small mistakes in subject to or seller financing deals can lead to significant financial or legal complications. You should also build a reputation for integrity. In private lending and partnerships, your track record is often more important than your capital. Delivering on commitments, even small ones, helps you build long-term access to funding sources. Another important aspect is structuring win-win deals. Creative financing works best when both parties benefit. Sellers often prioritize speed, certainty, or relief from financial burden over maximizing price. Understanding this allows you to design offers that solve real problems. You can also combine multiple strategies. For example, a subject-to deal can be paired with a lease option exit strategy, allowing you to control, cash flow, and potentially sell the property later. This layering of strategies increases flexibility and profitability. Over time, mastering creative financing transforms your investing capability. It allows you to operate in markets and deal sizes that would otherwise be impossible with limited capital, if executed with discipline and consistency over time. Part 5 focuses on risk management and scaling your real estate activities. Once you begin executing deals with limited capital, protecting your funds becomes just as important as growing them. Many beginners fail not because they cannot find opportunities, but because they take on unnecessary risk without proper evaluation. One of the first principles of risk management is understanding your downside before entering any deal. This means calculating worst-case scenarios, such as vacancy periods, repair costs, or buyer defaults. If a deal cannot survive conservative assumptions, it should be avoided. Diversification is also important. Even with less than $5,000, you can spread your exposure across different strategies, such as wholesaling, crowdfunding, and lease options. This reduces reliance on a single income source and stabilizes your progress. Scaling in real estate does not always mean buying more properties. It can also mean increasing deal volume, improving efficiency, or expanding your network. Systems such as CRM tools, automated marketing, and repeatable outreach processes allow you to handle more opportunities without increasing workload proportionally. Avoiding emotional decision-making is another key factor. Many new investors get attached to deals and ignore warning signs. Successful investors rely on data, not emotion, when evaluating opportunities. Finally, documenting your processes is essential for scaling. By tracking what works and what does not, you create a repeatable system that can be improved over time. This turns investing from random activity into a structured business model. To further strengthen your scaling ability, you must develop a clear feedback loop. Every deal you analyze, whether successful or not, should be reviewed to understand what contributed to the outcome. This helps you refine your criteria and avoid repeating mistakes. Time management also becomes critical as you scale. With limited capital, your time is one of your most valuable resources. Prioritizing high-impact activities such as lead generation, negotiation, and relationship building ensures better returns on effort. Building a support network is another key factor. Surrounding yourself with experienced investors, mentors, or accountability partners can accelerate your learning curve. Their insights help you avoid common pitfalls and identify better opportunities faster. You should also focus on improving your decision speed. In competitive markets, hesitation can lead to missed deals. However, speed must be balanced with analysis to avoid rushed mistakes. Developing frameworks for quick evaluation helps maintain this balance. As your experience grows, you can begin reinvesting profits into larger or more stable opportunities. This compounding effect gradually increases your capital base and opens doors to more advanced strategies. Ultimately, risk management and scaling are about control. The more structured your approach becomes, the more predictable your outcomes will be, allowing you to grow consistently even with a small starting budget. Maintaining emotional discipline during market fluctuations is essential because volatility can lead to impulsive decisions that damage long-term progress. Investors who stay focused on strategy rather than short-term noise are more likely to preserve capital and consistently identify strong opportunities, even in uncertain conditions.
Part 6 is the execution roadmap that ties everything together. At this stage, you understand the strategies, deal sourcing methods, creative financing, and risk management principles required to invest in real estate with less than $5,000. The final step is turning this knowledge into consistent action. The first step is setting clear goals. Define what success looks like for you within the first 90 days. This could include finding your first deal, closing a wholesale transaction, or securing your first crowdfunding investment. Clear targets create accountability and direction. Next, you must build a daily routine. Successful investors treat real estate like a business, dedicating time each day to lead generation, learning, and outreach. Consistency is more important than intensity. Small daily actions compound into meaningful results over time. You also need to focus on execution over perfection. Many beginners delay action because they feel unprepared. However, real estate rewards those who learn through doing. Mistakes are part of the process and often provide valuable insights that theory cannot offer.
Tracking your progress is essential. Maintain records of deals analyzed, contacts made, and strategies tested. This helps you identify patterns and improve decision-making efficiency over time. Finally, stay committed to long-term thinking. Real estate wealth is rarely built overnight, especially with limited capital. However, with persistence, discipline, and strategic execution, small beginnings can evolve into significant financial growth. This concludes the framework for investing in real estate with less than $5,000. The key is not just knowledge, but consistent application of that knowledge in real market conditions. To strengthen your execution further, you should also focus on building resilience. Real estate investing involves rejection, failed negotiations, and missed opportunities. Developing the ability to stay consistent despite setbacks is what allows long-term success. Another important factor is continuous learning. Markets evolve, regulations change, and strategies improve over time. Staying updated through books, mentorship, and real-world experience ensures you remain competitive and adaptable in different economic conditions.
Accountability systems can also improve your performance. Working with a partner, mentor, or accountability group helps you stay disciplined and prevents procrastination. Regular check-ins force you to evaluate progress honestly. You should also refine your communication skills. Whether dealing with sellers, investors, or lenders, clear and confident communication increases trust and improves negotiation outcomes. This includes both written and verbal communication. As you grow, reinvesting your profits becomes essential. Instead of spending early gains, channel them back into new deals or education. This accelerates compounding and increases your ability to scale faster. Ultimately, success in real estate with limited capital is a function of persistence, strategy, and execution. Those who stay consistent over time will naturally outperform those who rely solely on initial capital. In the long run, your ability to combine discipline, adaptability, and strategic thinking will determine how far you progress in real estate investing. Small, consistent actions, when repeated over time,
Create momentum that transforms limited starting capital into meaningful financial independence and long-term wealth creation opportunities ultimately achieved. At this point, you should understand something very clearly. Real estate investing is not a capital game. It is a knowledge and positioning game. The $5,000 barrier only exists for people who are trying to buy property the traditional way. But once you understand wholesaling, seller financing, lease options, partnerships, and crowdfunding, you realize that money is often the least important part of the equation. The real advantage goes to the person who can find deals, structure opportunities, and solve problems for sellers and investors. Your next step is not to wait, but to act. Start learning your local market, start identifying deals, start building relationships, and most importantly, start small but consistent. Because in real estate, your first deal is never about profit. It is about proof that you can do it. Once you have that, scaling becomes a process, not a mystery.